This is now week 7, and this is lecture 2 for week 7. So today you will see a new topic. This is topic 5. Topic 5 is about financial statement analysis. Okay, what is the financial statement analysis? So financial statement analysis is like this. In the previous topic, you have seen or you have learned how to prepare the income statement and balance sheet. Okay, you can see here. This is the format for income statement. See the income statement. Revenue minus expenses, you will get net income or profit. Income statement shows the performance of a business. If the business is making profit, then you can say that the business is good. The business is performing well. But if the business is making loss, in general, you can say that the business is not good or not performing well. This is the balance sheet. You have learned how to prepare a balance sheet in the previous topic. So you can see here the format is like this. In the left side of the balance sheet, you have to list all the assets. See here the examples are cash, supplies, land, and the total is 26,450. And in the right side of the balance sheet, you have to list all the liabilities and honest equity. Okay, remember this. Balance sheet shows the financial condition of a business. If you see in the balance sheet the amount of liabilities is small compared to the amount of asset, then you can say that the business is in a good financial condition. But if you see that in the balance sheet the amount of liabilities are very big, maybe let's say the amount of the liabilities is 70% compared to the asset, then you can say that the business is not in a good financial condition. So when you want to say something about the financial condition of a business, you look at the liabilities compared to the amount of total asset. The reason is if a business has high liabilities, the business is in a bad financial condition, because every month the business has to pay back the debts or liabilities. So very difficult for the business to survive. Okay, so that is in general. When you see an income statement, you can see the financial performance of the business in general, and if you see the balance sheet, you can see the financial condition of the business in general. But you can only make a good conclusion about a business financial performance and condition after you analyze its financial statement. If you see these two statements only, you can make a general conclusion only. But if you want to make a good conclusion, an accurate conclusion about the business, you have to analyze this income statement and balance sheet. That is the thing that you will learn in this topic. You will learn about how to analyze the financial statement. Okay, let's see what's the purpose of financial statement analysis. Why people do financial statement analysis? Okay, let's see the first point. To begin, it is examining relationship and trends among financial statement numbers. So financial statement analysis is something about examining the relationship and trends among financial statement numbers. You will learn about how to see the trends and relationship between the asset, liability, and equities. Financial statement analysis, when you do financial statement analysis, you will use past performance to predict future performance of a business. And then to evaluate performance with the goal of identifying problem areas. So this is the last sentence, or the last point is the most important thing. Financial statement analysis is both diagnostic and prognostic. So if somebody it means that people do financial statement analysis for diagnostic. Diagnostic means to identify problems with a business. And second thing is people do financial statement analysis for prognostic. Prognostic means to predict the future of a business. So if there is a question asked you, list the purposes of doing financial statement analysis. So the answer is there are two purposes of doing financial statement analysis. The first one is diagnostic, or to find problems with a business. Second, the purpose of doing financial statement analysis is prognostic. That is to predict the future of a business, whether the business going to be better or going to be worse. Okay. Okay, another thing is there are many people who will do the financial statement analysis. Okay, these people can be grouped into two. Categories. External users and internal users. Okay. For external users, lenders, for example. Lenders are parties who give loan. They do financial statement analysis. Why they do financial statement analysis? Because they do the analysis because they want to make a lending decision. Lenders like bank and financial institution, they do financial statement analysis because they want to make lending decision. They want to decide whether to give loan or not to give loan. For example, let's say in the future you have a business, you want to make bank loan for your business. So most of the time, the bank will ask you to submit financial statement to them. So the bank officer will do financial statement analysis and decide whether to give loan to your business or not. Okay, there are several things that the bank officer will look in the financial statement. They will do several types of analysis. But the purpose is they do the financial statement analysis to make lending decision. External users. Another external users is creditors. You know, creditors are most of the time suppliers. Suppliers, they give credit to businesses. Let's say you have a business in the future. If you want to purchase supplies or inventories, most of the time you will purchase the supplies or inventories from suppliers in credit. You take the inventories and supplies first, you will pay later. That is a credit transaction. So the suppliers who give the credit, before they give the credit, they most of the time they will do financial statement analysis. If the supplier sees that the business is a good business, when they do the financial analysis and they found that the business is good, then they will give the credit, or they will allow credit transaction. If the supplier sees that the business is not good, then they will not allow a credit transaction. So creditors do financial statement analysis to make credit decision. They do financial statement analysis to decide whether to give credit or not to give credit. Another party that will use the financial statement analysis or do financial statement analysis is labor union. Labor union, they every year they will do financial statement analysis. If they see that the business is performing well, most of the time they will ask for salary increment, bonus, etc. And then also I have seen that in some textbooks they said that NGOs particularly related to environment like Greenpeace or other NGOs related to the environment, they also do financial statement analysis. They want to see whether businesses making profit or not. If businesses are making good profit, and then NGOs will ask them to for fund, ask them for funding or contribution, because this NGO do something to the environment. So if it is good for big businesses if they donate something to the NGOs, so the NGOs can do their activities to preserve the environment or to do something good for the environment. Okay, there are many other, I think there are several more examples. You can look at the textbook. External users. The most important thing one is investor. Investor, they do financial statement analysis to make investment decision. Investors are people who purchase shares of business. So most of the time, before an investor invest in a business, they do financial statement analysis. If the business is good, then they purchase the shares of the business. If the business is not good, they do not purchase the shares. Okay, that kind of thing is called investment decision. So investors do financial statement analysis to make investment decision. Internal users. Okay, I hope you can remember internal users. Internal users, the main internal user is the manager of a business. So manager of a business, they do financial statement analysis because they want to make management decision. Manager has to make many business decision every day, to set price for the product, to decide how many workers to be hired, to decide whether the business should open a new branch or not, etc. So when the manager want to make this kind of business decision, the manager has to analyze financial statement, do some analysis, and then make the business decision. Shareholders of a business is also an internal user. So shareholders also make financial statement analysis so that they can make good investment decision also. If the shareholders see that the business has a good future, then the shareholder will purchase more shares, or at least keep their shares. But if a shareholder sees that the business is getting worse, then the investment decision that the shareholder will make is to sell their shares or do divestment. Okay. Okay, horizontal analysis. Okay, in this course, you will learn 3 methods that can be used to make financial statement analysis. The first method is called horizontal method or horizontal analysis. So you can imagine a horizontal line. Okay, so see here the horizontal analysis. the thing that is written here is the percentage of analysis of increases and decreases in related items in comparative financial statement is called horizontal analysis. Okay, I hope you can imagine a horizontal line. So this is the way to do horizontal analysis on a balance sheet. So let's say, okay, let's see. So if you want to do horizontal analysis for balance sheet, you have to have 2 years data, current year data and previous year data. So in this example, see, there is a business called Lincoln Company. You want to do financial horizontal analysis for this company's balance sheet, so you have to have 2 years data. The current year data is here is the 2000x2 data. That is the current year balance sheet. And the previous year data is the balance sheet for year 2000x1. Okay, make sure you have 2 years data, and then when you want to make horizontal analysis, you have to prepare column number 4 and number 5. Column number 5, you see here, column number 4, you see there, you have to show an increase or decrease in the amount of every item. For example, here you can see here current asset, the amount increase or decrease is 17,000. The amount, that one is amount increase, because in year 2000x1 the current asset is 533,000. In year 2000x2 the amount of current asset is 550,000. So there is an increment of 17,000. So that is the thing that you have calculate. And then how to calculate the percentage? To calculate the percentage, you have to use the previous year data as the basis, as the base of the calculation. So 17,000 divided by 533,000, you will get 3.2% increment. Okay. Long-term investment. See, long-term investment. First, you have to calculate the amount of increase or decrease. So there is a decrement here, 177,000 in 2000x1, decrease to 95,000 in 2000x2. So the amount of decrement is 80,500, and you have to calculate the percentage of the decrement. 82,500 divided by 177,500, you will get the decrement is 46.5%. So you have to calculate that for every item in the balance sheet. Okay, that is the first thing. When you want to do the horizontal analysis for the balance sheet, first you have to prepare column number 4 and number 5, and after that, the second thing is you have to know how to interpret the data. Okay, for example, how to interpret the data. So you can see here, when you analyze the balance sheet, you have to focus on the total liabilities and total asset. So if you do not analyze this financial statement, you will see that the business is getting worse. See, if you do not do the financial statement analysis, you will say that the business is getting worse, because in year 2000x2 the total asset of the business is 1,139,500. In the previous year, in year 2000x1, the total asset of the business is 1,230,500. So if you look at only this number, these two numbers, then you will say that the business is getting worse because the asset is getting less. But let's see what is your conclusion after doing the analysis. So like I said earlier, when you do the analysis for balance sheet, you always look at the total liabilities and total assets. So you can see here, when you check the total liabilities, you can see in the column number 4, the total liabilities has decreased. How much the decrement? 133,000. And in terms of percentage, the decrement is 30%. So you can say that the business condition is getting better, because like I said earlier, when you check the balance sheet, you want to you can see the financial condition of a business. So if the business liabilities has decreased, see here that in this example, the decrement is 30%. That is a big decrement. So you can say the business financial condition is getting better. That is the way to interpret the numbers. So focus on the liabilities, total liabilities and total asset. So this shows how the blue box shows how to do the horizontal analysis. Like I said earlier, you have to calculate the amount of decrement or increment, and then you have to calculate the percentage. Okay, now this is about how to do horizontal analysis on a business income statement. Okay, income statement, the format for being income statement is very straightforward. I hope you can remember. The format is revenue minus expenses. So this income statement in this slide is a bit complex, because this is an income statement for a merchandising business. So it is a bit complex. But for a income statement for a service business is very simple, revenue minus expenses. But the way to do the horizontal analysis on the income statement is same, whether the business is manufacturing business or merchandising business or service business. The way to do the horizontal analysis is same. So how to do the horizontal analysis for this income statement? So when you want to do the horizontal analysis for the income statement, you also have to have 2 years data. In this example, the data for 2000x2 and 2000x1. 2000x2 is the current year data, and 2000x1 is the previous year data. So you have to have 2 years data. After that, you have when you want to do the horizontal analysis, you have to prepare column number 4 and number 5. Okay, you have to show the amount of increment or decrement, and also the percentages of the increment or decrement. So every item you have to show that. For example, here the sales is for year 2000x2 or the current year is 1,530,500. 2000x1, the previous year, is $1,234,000. So see in the column number 4, the amount of increment in the sales is 296,500, and the percentage of increment is 24%. How to calculate the 24%? 24% is equal to 296,500 divided by 1,234,000. So let's see. See there? So that is the way to calculate the increment or decrement in terms of percentage and in terms of amount. So you have to do that for every item. You have to do that for every item. Okay, that is the first thing. You have to know how to prepare the column number 4 and 5. And the second thing is you have to know how to interpret the data. Okay, how to interpret the data. Now, Let's say you do not do this analysis. What is your conclusion? So if you do not do this analysis, you only see the column number 3 and 4. So when you see the column 3 and 4, you will say that the performance, the financial performance of this business is good, is getting better, because in year 2000x1 the profit is 76,500. In the year 2000x2 the profit increases to $91,000, and then you will say, oh, this business is good, it's getting better because the profit has increased. Okay, that is your conclusion, your general conclusion. If you do not do the analysis, what is your conclusion after you do the financial statement analysis horizontal method? So let's see. Now you do the horizontal method analysis. You have column number 4 and number 5. Okay, you can see here, when you do financial statement analysis for the income statement, you focus on the total revenue and total revenue and profit. See here, you can see the total revenue has increased. How much is the increment? 296,500. The percentage of increment is 24%. That is good. And then you see the profit. The profit or net income has increased by 14,500. That is good. The percentage of increment in the profit is 19% only. So now, what is your conclusion? You will say that the business is getting better in terms of performance or not? The conclusion that you can make after doing this horizontal analysis is, maybe the performance of the business is not good. It's not getting better, because you can see here, for this business, the increment in sales or revenue is 24%, but the increment in profit only 19%. So we cannot say that is a good thing, because if a business is a good business, then the increment of sales by 24% or the increment in revenue of 24%, if the sales or revenue increase by 24%, the profit must increase at least equal to 24% also. For this business, the sales increase by 24%, but the increase in profit is only 19%. That is not good. Okay, so think about it. That is the conclusion. So maybe for this business, there is the business is not getting better in terms of performance, because sales increased by 24%, but profit increased only by 19%. If you check in detail, you will see that there are several reasons for this situation. First, you can see there, the cost of goods sold increased by 27.2%. So it shows that when sales or revenue increased by 24%, the cost of the business increased more. The increment in cost is 27.2%. The increment in selling expense is more than that, 29.9%. So it shows that even though the revenue has increased, this business is not good, because the cost increased more than the increment in revenue, and also the selling expenses increases more than the revenue. So that is the thing that you have to see. Okay, this is the way to prepare the column number 4 and 5. You calculate the difference and you calculate the percentages. Okay, so focus on how to do the horizontal analysis on the income statement and balance sheet only. So that is an example. The comparative cash and account receivable for a company are provided below. Cash 62,500 and 50,000 in the previous year. Account receivable 74,400 and 80,000 in the previous year. Based on this information, what is the amount and percentage of increase or decrease that will be shown in a balance sheet with horizontal analysis? So that is okay. How to do that? Okay, that is the way. I think you know this. I explained the way to calculate the amount of increment and decrement, and also the percentages for the increment and decrements. Okay. Okay, the second method that can be used to do financial statement analysis is called vertical analysis. See there in this slide, a percentage analysis used to show the relationship of each component to the total within a single statement is called vertical analysis. So vertical analysis, imagine a vertical line. Okay, that is a vertical analysis. So let's say the vertical analysis of a balance sheet, each asset item is stated as a percent of the total asset. Each liability and stockholders' equity item is stated as a percent of the total liabilities and stockholders' equity. So this is the way to do the vertical analysis. The vertical analysis can be done if you have 1 year data, but if you have 2 years data, it is better. Okay, so see here how to prepare how to do the vertical analysis on a balance sheet. See here, the business is Lincoln Company. So the way to do it is, okay, you have to have the balance sheet data, and then you have to calculate the percentage. So see here, in this slide, balance sheet for the year 2000x2, you have the amount with current asset 550,000, long-term investment 95,000, property, plant and equipment 444,500, intangible assets 50,000. So you have the data, the amount, and then you have to prepare the column number 3. You have to calculate the percentage for each item in the balance sheet. So see here, when you calculate the percentage for asset, you have to make total assets equal to 100%. Okay, so you have to make the total asset as 100%. So when the total asset is 100%, then you can calculate the percentages. Okay, see, current asset, the total asset is always equal to 100%, and the total liability and stockholders equity also is always equal to 100%. So you can use that number as the basis of your calculation, 100%. So after you have calculated, when you use these two numbers as 100%, then you can calculate every item, percentage for every item. Current investment in year 2000x2 is 48.3%. In 2000x1, 43.3%. Okay, that is the first thing. You have to know how to calculate the percentage, and then after that you have to know how to interpret the number. Focus when you do financial statement analysis on a balance sheet, you focus on the total liabilities and total asset. You can see here, in year 2000x2, the total liabilities is 27.2%. So it shows that the business is in a good financial condition, because the amount of liabilities is very small compared to the total asset. The cut-off that we use in accounting is, if a business has liabilities more than 50% of asset, then the business is not in a good financial condition. If you do vertical analysis and you see that the total liabilities of a business is less than 50% of the total asset of the business, then you can say that the business is still in a good financial condition. This business, the total liabilities is 27.2% compared to total asset, so it is still a good the business is still in a good financial condition. Okay, that is how to do the horizontal analysis on a balance sheet. Sorry, the vertical analysis. Okay, how to do that on an income statement? So you have to do the same thing. You can do vertical analysis if you have 1 year data, but if you have 2 years data, it is better. It is good. So see here how to do that. Vertical analysis. So always imagine a vertical line. You have to do that. So let's say, see here, you have an income statement. The current year is 2000x2. You have the data, and then if somebody asks you to do a vertical analysis, then you have to prepare the column number 3. If you have 2 years data, you have to prepare column number 3 and column number 5. So see column number 3. Okay, for income statement, remember this. The total sales for in this example, net sales is always equal to 100%. That is the 100%. And then this is the way to do the calculation. The net sales or total sales is always equal to 100%. So you can calculate the percentage. This is the percentage for selling expenses. 191,000 divided by net sales or total sales, 1,498,000. The percentage is 12.8%. Okay. This is the thing that you have to do. Like I said earlier, when you want to do this calculation, when you want to do analysis, financial statement analysis on an income statement, you look at the total revenue or total sales and the total profit or net income. In this example, the net income is 6.1% compared to the total net sales or revenue. So how first you have to know how to do this, to prepare or to do or to make column number 3 and 5. After that, you have to know how to interpret the data. So the first thing that you can do is you can see that the profit of the business is 6.1%. In general, it is good because the business is making profit. But to know whether the business is actually good or not, you have to compare the data with the industry average. Let's say this business is this business is a retail business or merchandising business. So you have to see what is the average percentage of profit or net income for businesses like this. Let's say in the market in Malaysia, we have many retail companies. We have Parkson, we have Eon Big, we have Sogo. So to know whether this business financial performance is good or not, we have to see the percentage of profit made by this retail companies in average. Let's say the market average or the retail business profit average is 8%, but the Lincoln company net income or profit is only 6.1%. Then the conclusion that we can make is the company is not in a good financial performance. 6.1% compared to industry average of 8%, not good. That is one thing that we can do. And then also, if we have 2 years data like this, we can compare the percentage of net income of current year with the percentage of net income in the previous year. So you can see here, in the previous year, in year 2000X1, the percentage of net income is 6.4%. But the current year, 2000X2, is 6.1%. So it shows that the business financial performance is not getting better. It's getting worse compared to the last year. So that is the conclusion that you can make. If you do not do the analysis, you will say that the business is in a good financial performance. But after you do the analysis, you can say that you can make a good conclusion, a better conclusion. You will see that the business financial performance is not getting better. Okay. Okay, that's it for lecture today. I have explained at the beginning of this video, I have explained what is financial statement analysis. Okay, and then who do the financial statement analysis? You have seen that people who do financial analysis are internal users and external users. Why they do financial statement analysis? They do financial statement analysis because they want to make decision. Investor want to make investment decision, manager want to make management decision, lenders want to make lending decision, etc. And also I have told you, in this course, in this topic, you will learn 3 financial statement analysis method. The first one is horizontal method. The second one is vertical method. And the next one, the last one, is ratio analysis. I will do the lecture about ratio analysis method in week 8. Thank you very much. Do not forget to write your name and matric number in the comment section. I will take that as your lecture attendance. Thank you very much.